Okay, we are recording. Hello again, everybody. Now we are going over chapter 2, PowerPoint together. So when we went over chapter 1, PowerPoint, I mentioned that in chapter 2, we really get into talking about more of the recording function and how we record these transactions. So we're going to talk more about debits and credits and how we record these transactions. And so we're going to obviously get practice, a good amount of practice with this in class together as well. But I just kind of want to show you guys what this process looks like. And then again, we'll get practice together with it in class also. So I am going to go ahead and share my screen with you, which is the chapter 2 PowerPoints. Of course, all these PowerPoints can also be found on Alnet as well. All right, and let me get this big screen here. All right. All right, so again, chapter 2, we're getting into really the recording function and how we record these transactions. So remember, in chapter 1, we talked about accounting, identifying, recording, and communicating, right? So in the recording function, we're looking at how to record these transactions. So the date they need to be recorded, the amount that needs to be recorded, and then whatever type of an expense it is or type of revenue it is or whatever, we would have a separate account code for each one of these that we use. So we're looking at how we record these and kind of that framework behind the recordings, okay? So we're looking at T accounts. We're looking at debits and credits. We're going to look at trial balance. We're going to look at financial statements. And again, we'll be getting practice with this in class together also. All right, so the T account. Basically, when we think about each one of these types of accounts, and remember we talked about several types of accounts in chapter 1. We talked about asset accounts like cash and accounts receivable and land and equipment and supplies and prepaid insurance, for example, right? We talked about several of these asset accounts. We talked about liabilities accounts, accounts payable, notes payable, unearned revenues. We talked about equity accounts, revenue, expense accounts, owner's capital, owner withdrawal. When we think about all of these accounts, each of these accounts has its own separate T account. And that's how we record transactions in each of these accounts separately. So now we're looking at our cash account, and it's showing us all of the ins and outs or all of the dollar amounts of transactions that have happened, okay? The balance of an account is always the difference between debits and credits. So if you see here, we've got debits, which are increases to cash. We've got debits of $109,070. $109,070, right? And then we have credits. Credits are decreases to cash, negatives to cash. So we've got credits of 53,180. So the balance of this account is the difference between the debits and credits. So if we take 109,070 minus 53,180, the balance of that account then 55,890, right? So the balance of an account is always the difference between the debits and credits. So what it's showing us here, again, we see increases to cash, decreases to cash. One side, namely the debit side for the cash account, are increases to the account. The credit side, which is the right side of the T account, are the decreases to cash, right? So always when we're thinking about these T accounts, and I know they're showing us the cash account, but remember, every single account would have its own ledger account or its own T account to go with it, right? Ledger account, T account, they mean the same thing, yeah? So each one of these is accounted for individually, okay? So in each T account, debits are always on the left, so this is always the debit side of the T account. Credits on the right, so this is always the credit side of the T account, right? And the normal balance of an account is whatever side increases it. So when we think about cash, cash increases with a debit. Cash increases on the debit side. So cash has a normal debit balance. As we're going to see when we look at example of these, some accounts like liability accounts increase with a credit. So then liability accounts have a normal credit balance, right? So the normal balance of an account is just the side that increases it, okay? All right, so again, assets increase with a debit, decrease with a credit. So assets increase with debit transactions on the left side of the T account. They decrease with credit transactions on the right side of the T account. So again, assets increase on the left side, which again is called the debit side. Assets decrease on the right side, which again is called the credit side, okay? That's for all assets. And I know it's saying such as cash up here, but this would also be for accounts receivable, notes receivable, supplies, prepaid insurance, equipment, land, building, any asset increases with a debit, decreases with a credit. Liabilities are opposite, okay? So liabilities decrease with a debit, increase with a credit. And so that's what it's showing you here. Again, the left side of the T account is called the debit side. So liabilities decrease with a debit, decrease on the left side. And the right side of the T account is called the credit side. Liabilities increase on the credit side, on the right side of the T account. And then member owner's equity, or the owner's equity account, includes not only, you know, owner's capital investment, but also owner's drawings, owner's revenues earned, and expenses. So we've got to think about each one of these individually, because remember, when the owner invests capital into the company, that increases equity. And then when we earn revenue, that increases equity. But then when the owner takes out money, an owner drawing, that decreases equity. And then when we pay expenses, that decreases equity. Okay, so when we're thinking about the increases to equity, the capital investment, the revenue, owner's capital has a normal credit balance, which means it increases with a credit, decreases with a debit. Revenue, same thing. Revenue and capital both have kind of the same debit and credit rules because they both increase equity. Equity increases with a credit, decreases with a debit. Revenue increases with a credit, decreases with a debit, okay? And then for those accounts that decrease equity, it's the opposite. So then these accounts, drawing and expenses, they both decrease equity. So then for drawings and expenses, they increase with a debit, decrease with a credit. Again, expenses increase with a debit, decrease with a credit. All right, so it's showing us here, and this is one way to remember it, and I kind of like to write this on the board a different way, and when we get practice with these in class together, I'll, you know, again, I'll write them on the board a different way. But when we're thinking about, okay, you know, what accounts increase with the debit, what accounts increase with a credit, right? If we think about this little mnemonic memory device, so AID, A-D-E, assets, drawings, expenses, all increase with a debit. They have a normal debit balance. So they increase with a debit, decrease with a credit, right? Where then we think about liability accounts, capital accounts, revenue accounts. They all have a normal credit balance, which means they increase with a credit, decrease with a debit. All right, at this point, we would stop normally in class and we would do exercise 2-1 and exercise 2-2. So by all means, I would recommend you guys get a little bit of practice with these two exercises and make sure you're feeling good about this. All right, so recording the business transactions in the T accounts. This is similar to the steps that we looked at in chapter 1. Remember, in chapter 1, we looked at, kind of the steps to analyze a transaction. And now we're just kind of taking that one step further. So just like we did in chapter 1, we still have to think about what accounts are involved. We still have to think about what are the classifications of the accounts. Are they assets, liabilities, revenue, expense account? What are the classifications of the accounts? What accounts are going to be increased or decreased? And then again, we're looking at taking this one step further now to record this transaction as either a debit or credit. So record the transaction with a debit to one account, a credit to another account. And then is the equation remaining balanced after the transaction? So, we really already have looked at examples of this in chapter 1, but now again, we're just taking that additional step, in this case, step 4, to record the transaction as either a debit or a credit. All right, so here's one of the transactions we looked at in chapter 1. Connor deposited $90,000 in a bank account in the name of the business. Okay, so remember when we looked at this in chapter 1, we said, okay, now our asset has $90,000 on one side, our equity has $90,000 on the other side. The accounting equation remains balanced, right? But now we take that one step further and we see how we would record this is we would have a debit to cash, a credit to owner's capital. Because remember, cash increases with a debit. So cash is going up, and then owner's capital, which is part of equity, owner's capital increases with a credit. So owner's capital is going up. All right, here's another one that we looked at in chapter 1. Connor's Whitewater Adventures bought equipment paying cash of $38,000. So remember, when we looked at this example in chapter 1, we had equipment going up, cash going down, right? We bought equipment with cash. So we paid for the equipment with cash. So the equipment, which is an asset account, is going up, cash is going down. And so how we would record this is we'd have a debit to the equipment. So equipment increases with a debit, a credit to cash. Cash decreases with a credit. All right. Transaction C, Connor's Whitewater Adventure bought equipment on account, $4,320. Remember that on account means we did not pay cash. We basically created a debt now that we have to pay off. So in this case, we've got equipment going up with a debit. So we're debiting equipment, $4,320. We're crediting accounts payable, $4,320. Again, equipment falls under assets. Accounts payable is a liability, a debt that we owe. So we're debiting equipment, crediting accounts payable. And that's going to be a common theme as we go through this. Accounting, it's really considered a double entry accounting system because for every debit, there has to be an equal credit. So we have to have a debit and a credit with every transaction. There has to be a debit and a credit, right? So we're going to continue to see this as we go through and look at examples of this together. All right, here's our next one. Connor's Whitewater Adventure paid Signal Products, a creditor, $2,000. Okay, so we owed this balance to Signal Products, and now we're paying it off. So, in chapter 1, we use the example of like when we pay our credit card payment, right? We pay a credit card payment, cash is going down, but then also what we owe is going down. So in this case, we would debit accounts payable, that decreases accounts payable. So we would debit accounts payable, which decreases accounts payable. We would credit cash, which decreases cash. So we're decreasing what we owe, we're decreasing our cash. All right, J. Connor invests her personal computer with a fair market value of $5,200. So again, the owner's making an investment into the company, and just like when we saw the cash investment in transaction A, we're increasing owner's capital. We are increasing equipment, right? So equipment's an asset. Equipment increases with a debit. And then owner's capital, that's part of equity, that increases with a credit. So this journal entry would be debit equipment, credit cash. Debit equipment, credit owner's capital. And that's kind of the standard form of a journal entry. Standard form of a journal entry, we always list the debits first, then the credits. Excuse me. Connor's Whitewater Adventure sold rafting tours for cash, $8,000. So again, we're bringing in cash for earning revenue, right? We're earning revenue, the customer's paying cash. So we've got cash going up, cash increases with a debit. And then we've also got revenue going up. Revenue increases with the credit. All right, Connor's Whitewater Adventures paid rent for the month $1,250. So now we're paying an expense, rent expense in this case. So, you know, just like if we paid rent in our personal lives, right? The expense would be going up, our cash would be going down. So that's what we see here. Now expenses increase with a debit. And then of course, cash decreases with a credit. So on this journal entry, we would debit rent expense, $1,250, credit cash, $1,250. All right, the next one, Connor's Whitewater Adventures bought items on account. Remember that on account means the same as on credit, essentially. We did not pay cash. We created a debt that we're going to have to pay off at a later date. So in this case, the items that we bought on account are supplies. So we see our supplies account going up, $675, but then we also owe for these now. So our debt, our liabilities are going up, $675. So we've got debit to supplies, credit to accounts payable. All right. This transaction, we're purchasing a 3-month liability insurance policy for $1,875. So, you know, we're going to have prepaid insurance going up, cash going down. Those are both asset accounts. So we see them both under this asset column. Prepaid insurance, you know, remember this is prepaid insurance because it's a hot dog. Because it's a 3-month policy. So if it was just 1 month expense, then we would, instead of debiting prepaid insurance, we would debit insurance expense, right? If it was just a 1 month expense, then we would just debit insurance expense. But this is a 3-month policy. So this is an asset to us because we're going to have it for 3 months. So in that case, we're debiting prepaid insurance, which of course increases prepaid insurance. We're crediting cash, which of course then decreases cash. All right, our next example, the bill for newspaper advertisement from the Times, $620. So we haven't paid this bill yet. It doesn't say, you know, we received a bill for advertisement and paid with cash, right? It just says that we received the bill for newspaper advertisement from the Times, $620. So we've got to record the expense, but we haven't paid it yet. So then we put it into our accounts payable account. So in this case, again, expenses increase with a debit. So we're debiting advertising expense, $620. We're crediting accounts payable, $620. All right, our next example, providing 27 one-day rafting tours and billing Crystal River Lodge for $67.50. So we've provided this whitewater rafting services, and now we're sending this Crystal River Lodge a bill. And we got to wait to get paid. Remember, when our customers owe us money, we call that accounts receivable. That's an asset to us. So what's happening here is we've got accounts receivable going up because we're sending these customers a bill. They owe us this money now. And this is how we earn revenue. This is one of the ways we earn revenue. So then we've got income from tours, or our revenue account, going up. So that happens with a debit to accounts receivable. and a credit to income from tours. Credit to the revenue account, essentially. All right, at this point, we would stop. We would do practice exercises 2-3 and 2-4. Although I cannot make you do that through the computer, I would recommend that you get practice with exercise 2-3 and 2-4 to make sure that you are understanding this well enough. What's good about the exercises at the end of the chapter is that many of them give us like check figure amounts to make sure we're doing our calculations right. So again, once we're done with the chapter 2, I will be giving you guys the solution manual so you can go through and look at anything that might have been done incorrectly and double check yourself and all that jazz. So. Okay, so once we've done all of our transactions for the month, and we just saw several of them together, once we've recorded all of our transactions for the month, we've updated our T accounts, then from those T accounts, we prepare what is known as the trial balance. So that's what we're looking at here, trial balance preparation, right? So the trial balance basically lists all of the accounts that have balances, and then any of the accounts that have a debit balance are listed on the debit, in the debit column of the trial balance. Any accounts that have a credit balance are listed on the credit or the right-hand side of the trial balance. So that's what it's showing us here. So the listing of account balances in 2 columns. The left column represents accounts that have debit balances. The right column represents accounts that have credit balances. And then just like it shows here, generally speaking, this trial balance is prepared in this order. So we would always list our balance sheet accounts first. The balance sheet accounts and equity accounts, asset, liabilities, capitals, drawings. Those are our balance sheet or our owner equity accounts. And then revenues and expenses are our income statement accounts. And this is kind of that standard format of the trial balance. All right, so here's an example out of your book of that trial balance. Again, we have all of our account titles or account headings here. And then any of the accounts that have a debit balance, those amounts are listed in the debit column. And any of the accounts that have a credit balance, those amounts are listed in the credit column. And we make sure that just like we do, you know, on that accounting equation, after each transaction, the accounting equation should remain balanced. And that's the same thing with the trial balance. We do the trial balance throughout the accounting cycle. This is actually the trial balance. There are 9 steps in the accounting cycle, 9 steps in the accounting cycle. Of those 9 steps, preparing a trial balance is 3 of those 9 steps. So we do this trial balance periodically throughout the accounting cycle to make sure we have equality between the debits and credits. Right? So we want to make sure before we prepare our financial statements that debits equal credits. Because if they do not, something has been recorded incorrectly. So it's really like a check, you know, a checkpoint, if you will. All right. At this point, I would encourage you to stop and get practice preparing one of these trial balances, exercise 2-5. All right, so once we've prepared our trial balance, now we can get practice with our financial statements because we prepare financial statements right from the trial balance, right? So all of the information that we need to prepare our financial statements, and our main financial statements are the income statement, the statement of owner's equity, the balance sheet, and the statement of cash flows. Those are our 4 main financial statements. And we'll get practice with the first 3. We'll get practice with the income statement, the statement of owner's equity, the balance sheet. Statement of cash flows is a little bit higher level accounting function, so that we get to get a lot of practice with actually in intermediate accounting. But we're going to focus on the basic financial statements, which are the income statement, the statement of owner's equity, and the balance sheet. So as I mentioned before, our income statement, we calculate our net income by taking revenue minus expenses. Okay, revenue minus expenses equals either net income or net loss. So when we have a net income, that means that we had more revenue than expenses. So just to make the math easy on my brain, let's say that we had 1,000 in revenue and we had 300 in expenses. 1,000 in revenue minus 300 in expenses means that we had 700 net income, right? So net income is when our revenue is greater than our expenses, we earn a net income or net profit as it's referred to sometimes. When it's the opposite, when revenue is less than expenses, there's a net loss. We've lost money. We have less revenue than our expenses. Our expenses exceed our revenue, so we've suffered a net loss over that accounting period. All right, so here's an example of that income statement. So again, we've got revenue, in this case, income from tours. So we've got revenue, 23,320. Now we list our expenses here. We've got 4 of them. So we've got total expenses, $4,455. So we take 23,320 minus 4,455, which means we had a net income of 18,865. Not too bad. On your first exam, you have to be able to prepare a basic income statement like this. And it really is just this simple. Revenue minus expenses equals net income. Okay? And then this net income amount, 18,865, this flows to our statement of owner's equity. So we'll see that, and it says that here. Transfer net income figure to statement of owner's equity. So this 18,865, this number transfers to or flows to or shows up on our statement of owner's equity as well. All right, so the statement of owner's equity shows the change in owner's equity over an accounting period. And the basic formula for this is we're going to take the beginning balance of equity. Then we're going to add net income or subtract net loss. And then we're going to subtract, if the owner took any money out, subtract owner withdraws. And that gives us the ending balance in equity. All right, so here's an example of this. So we take beginning balance, 95,200, plus net income. Remember, if it was a net loss, we would subtract it. But because we earned a net income, we're going to add it. Otherwise, if it was a net loss, we would subtract it. But it's a net income, so we're going to add it. So we take beginning balance plus net income. That gives us 114,065. And then we want to subtract owner withdrawals. Right? The owner took out 3,500 out of the business. So we subtract withdraws, and that gives us our ending balance in equity. All right, so we took beginning balance plus net income minus owner withdraws. That gives us ending balance. All right. Oh, and then I forgot to mention too, and I know it shows it here, but this ending balance in equity transfers to the balance sheet. So the ending balance in equity flows to the balance sheet. All right, so now the balance sheet shows us our assets, liabilities, and equity. So you know, there's a formula to the balance sheet, just like the income statement, the statement of owner's equity. What we do for the balance sheet is we use that basic accounting equation, assets equal liabilities plus equity. So we're going to list all of our assets. We're going to add those up, total assets. And then we're going to list our liabilities and equity, and then we're going to add those up, total liabilities and equity. And if we've done everything correctly, they should equal, right? Because that's that basic accounting equation. So here's an example of that. So we're adding up all of our assets. In this case, we've got cash, accounts receivable, supplies, prepaid insurance, equipment. So we've got total assets, 113,990. And then we're going to add our liabilities and equity. We've got liabilities 3425, equity 110,565. Remember, that was the balance from our statement of owner's equity. So we add those two together. That equals our total liabilities and owner's equity. And just like it shows here, total assets equal total liabilities and owner's equity. That's that basic accounting equation. Again, for the first exam, you guys have to be able to prepare these three basic financial statements. So you have to be able to prepare the income statement, the statement of owner's equity, and the balance sheet, just like you see here. We'll get practice with them in class together. Not too bad, I think. Excuse me. At this point, I would recommend stopping and looking at exercise 2-6. And then problem 2-3B. I think problem 2-3B is one that we're going to do in class together. But again, I don't think that it would hurt if you took a look at it and kind of tried to work it out yourself before we do it together. All right. So finally, chapter 2 talks about errors in the recording process. So, you know, one of the ways, like I said, with, you know, debits and credits, debits always have to be equal to credits. Every time we record a transaction, debits have to be equal to credits. And in fact, most accounting software, at least any of the accounting software I've ever dealt with, kind of has those little like error messages in place where if you try to record a transaction and debits do not equal credits, it'll have an error message pop up and say, you know, this transaction cannot be recorded because debits do not equal credits, or, you know, whatever the case, you know, however the wording is. But usually there is like a little error message that'll pop up, so it won't let you record it unless debits equal credits. But you know, so that's kind of the most obvious error that can be made, is that, you know, we try to record a transaction, debits do not equal credits, right? There can also be errors made with arithmetic. So maybe not adding something together properly, or not subtracting something properly, recording only half of a journal entry. Maybe recording both halves of the entry on the same side, aka the wrong side, or recording one or more of the amounts incorrectly. So, you know, different errors that can be made. So kind of what we do when we think about locating some of these errors, like, you know, first of all, you know, we would look at probably the trial balance. If we pull a trial balance, again, we're at the end of the month. We've recorded all of our transactions for the month. We've recorded, we've done all of our journal entries. We've recorded all the transactions. Now we go to prepare the trial balance. Well, if we pull the trial balance, we pull that trial balance report and it doesn't equal, then immediately we know we have a problem, right? So we know we've got to go back and kind of look at some things. And one way is to see if, you know, one of the balances is off. So maybe, you know, the cash account, for example, cash has a normal debit balance. So if we see that the cash account has a credit balance, that's a problem. That would mean that our cash account was negative. That shouldn't happen, right? So maybe one way is to make sure that all the accounts have a normal balance. Like likewise, accounts payable has a normal credit balance. So if we see that accounts payable has a debit balance, that's going to be immediate red flag, because it should have a credit balance, right? We might recalculate or re-add the trial balance columns. We might double check the journal entries and make sure that the amounts were transferred to the T accounts properly, transferred to the trial balances from the T accounts properly. And then again, verify that we have added and subtracted correctly in those T accounts. And then we can kind of categorize errors into really two main categories, either transposing, transposition error or a slide error. And so just like it shows here, a transposing or a transposition error is when we transpose a number. So for example, we write 619 when it should have been 916. So we transposed the 6 and the 9. A slide error is when we there's an error when where the decimal point should have been. So for example, we wrote 27,000, but it only should have been 2,700. So we added an extra zero to it. So that decimal place is in the wrong place. And then it shows you down here that an error could also be a combination of these two things. So we could have transposed a number and had a slide error. So it says an error may be a combination of a transposition and a slide. An example would be if we wrote 54, but it was supposed to be 450. So not only did we transpose the 4 and the 5, but we added an extra decimal place. We added an extra zero there, which would not be a good thing, right? Because then that account would be off $396 or whatever. So anyway, okay. All right, at this point, I would recommend stopping and looking at exercise 2-7, exercise 2-8. Again, we're going to get practice with these in class together, but I don't think it's a bad idea to kind of test yourself as you're going and check for understanding throughout, so that if you do have any questions, we can discuss those further in class together. All right, and that concludes our chapter 2 PowerPoint. I am going to stop sharing that with you. Hi. Okay, and then of course these PowerPoints are all in OwlNet for you, so you can go through and look at these PowerPoints if you would like to as well. And then we will work some of these exercises and problems in class together. Woohoo, right? All right, bye everybody. I'll see you soon.